A credit ratings agency just downgraded Blackstone. The alarm bells should be ringing across every pension fund and retirement account in America right now. Moody's dropped Blackstone's credit rating by one notch, and the reason they gave should terrify anyone paying attention. It wasn't because Blackstone is failing. It wasn't because they're over-leveraged in the traditional sense. They downgraded Blackstone because of how much exposure the firm has built up in private credit markets. That single decision is a crack in the dam. And behind that dam sits over $2 trillion in loans that most people don't understand, can't see, and probably don't even know they own. These are loans made to mid-sized companies you've never heard of. They're sitting in portfolios that don't get repriced by the market every day. The valuations are based on internal models, not actual buyers and sellers. And when the economy slows down, when these companies start missing payments, those losses won't show up gradually. They'll appear all at once, and by then it will be too late to get out. So the question I wanted to answer in this video is simple but urgent. What happens when those loans start defaulting? What does that mean for your money if you're invested in funds that own pieces of this market? All of these institutional investors were desperate for yield. They had liabilities to meet, they had retirees to pay, and they couldn't get the returns they needed from treasury bonds paying 1 or 2%. Private credit offered 8%, 10%, sometimes 12% returns. It looked like the perfect solution. Higher yield than investment-grade bonds, lower volatility than stocks, and the funds marketed it as safe because the loans were senior secured, meaning they were first in line to get paid if something went wrong. But here's the part that concerns me, and this is the part that doesn't get talked about enough. Unlike publicly traded bonds, private credit loans don't get repriced every day based on market conditions. If you own a corporate bond, and the market thinks the company is getting riskier, the price of that bond drops immediately. You see the loss in real time. But private credit doesn't work that way. The funds that hold these loans use internal models to estimate their value. They make assumptions about default rates, recovery rates, and the probability that the borrower will pay them back. As long as the company keeps making interest payments, the loan stays on the books at par. 100 cents on the dollar. Even if the company's business is deteriorating, even if revenue is falling. Moody's is essentially saying that if a wave of defaults hits that portfolio, Blackstone's earnings and balance sheet could take a meaningful hit. The risk is high enough that it justifies a lower credit rating. Now, Blackstone isn't going bankrupt. Let me be clear about that. That's not what this downgrade means. Blackstone is one of the most sophisticated financial firms in the world. They have smart people, they have risk management systems, they have diversification across asset classes. But the fact that Moody's looked at their private credit exposure and decided the risk is significant enough to warrant a downgrade should tell you something about how Moody's views the broader private credit market. This is a ratings agency that gets paid to assess credit risk. They have access to data that most investors don't see, and they're publicly saying that the concentration of risk in private credit is a problem, even for a firm as large and well-managed as Blackstone. When I dug into the underlying loan data, here's what jumped out at me. A significant portion of private credit loans are made to companies owned by private equity firms. These are leveraged buyouts. The companies were already loaded up with debt when they were acquired. The private equity firm typically puts in 20 or 30% equity and finances the rest with debt. Some of that debt is traditional bank loans. Some of it is high-yield bonds. And increasingly, a large chunk of it is private credit. The loans are floating rate, which means as the Federal Reserve raised interest rates from near zero to over 5%, the interest expense on those loans went up dramatically. And it didn't go up gradually. It went up fast, and it stayed elevated. Let me give you a concrete example of how that plays out in the real world. Say a private equity firm bought a company in 2020. They financed the acquisition with a floating rate private credit loan at SOFR plus 6%. Back then, SOFR was near zero, so the company was paying around 6% interest on that loan. Fast forward to today, SOFR is over 5%. That same loan is now costing the company 11% or more. If the company's revenue didn't grow fast enough to cover that jump in interest expense, it's now burning cash just to service the debt. It might still be making interest payments on time, so the loan still shows up on the fund's books at par. But underneath the surface, the company is weakening. Margins are shrinking, cash flow is tightening. That's a warning sign. It means the company is under stress even if it hasn't defaulted yet. And the problem is that a lot of these companies are in the same boat. They're all facing the same headwinds: higher interest rates, slower economic growth, tighter consumer spending, rising labor costs. If the economy tips into a recession, a lot of these companies are going to hit the wall at the same time. And when that happens, the funds holding these loans are going to have to start marking them down. Not one at a time, not gradually, all at once. And that's when investors are going to realize that the 8 or 9 or 10% returns they were getting weren't actually low risk. They were just deferred losses that hadn't shown up yet. That's the micro story. Individual loans going bad, individual companies defaulting, but the macro risk, the systemic risk, is what happens when this starts happening at scale. And that's the part that no one in the industry wants to talk about openly, because talking about it makes it more likely to happen. Private credit funds are structured with something called a liquidity mismatch, and this is the part that should keep anyone invested in these funds awake at night. The loans they hold are illiquid. Gating means the fund tells its investors, sorry, you can't have your money back right now. We're suspending redemptions until market conditions improve. And once a fund gates, it sends a signal to every other investor in that fund and in similar funds. It tells them, get your money out now before they gate you too. That creates a run. Not a bank run in the traditional sense, but a run on private credit funds. Everyone tries to pull their money at once. The funds can't meet the redemptions without selling assets. The assets they do sell go at distressed prices. That forces other funds to mark down their portfolios because now there's a market price, and it's way below par. And the whole thing spirals. We've already seen this happen in real estate. Blackstone's BREIT fund, which is a private real estate vehicle, had to limit redemptions in late 2022. Too many investors tried to pull money at once. The fund didn't have enough liquid assets to meet the requests without fire-selling properties. So they capped redemptions. They told investors you can only take out a fraction of what you asked for, and the rest is going to have to wait. That caused a huge uproar. Investors were furious. Financial advisors who had recommended the fund felt blindsided. And it raised questions about whether private real estate funds were as safe and liquid as they'd been marketed to be. Private credit has the exact same structure. Same liquidity mismatch, same redemption terms. Same risk of a run if investors lose confidence. And if we hit a recession and defaults start spiking, I would expect the same dynamic to play out, except potentially on a larger scale because private credit is a bigger market than private real estate. Investors will want out. Funds won't be able to meet redemptions without selling loans at a loss. And the funds that do sell will push prices down further, forcing other funds to mark down their portfolios even if they're not selling. This is how liquidity crises cascade. It's not about one fund failing. It's not even about one firm failing. It's about the entire asset class repricing at once and no one knowing what anything is actually worth because there's no transparent market. There's no centralized exchange. There's no real-time pricing. It's all happening in the dark, and by the time you see the losses, it's too late to get out. Now, that's the bearish case, and I want to be fair here. They can force the company to cut costs, sell assets, bring in new management, or raise more equity. That's different from publicly traded high-yield bonds, where you often don't have that level of control. You're just a bondholder. You can't force the company to do anything until they actually default. Private credit lenders have more tools to protect themselves before things get truly ugly. Third, the sponsors matter. The private equity firms that own these companies have skin in the game. They have equity invested. If a portfolio company defaults, the private equity firm loses its equity stake entirely. That's a total loss for them. So, in many cases, the private equity firm will inject more capital into the company, or negotiate an extension on the loan, or bring in a new investor rather than let the company go under. They have an incentive to keep the company alive because their reputation is on the line and because they want to preserve optionality for a future exit. That doesn't mean they'll always succeed, but it does mean there's another layer of support that might prevent defaults from happening as quickly or as severely as they would in a market without sponsors. And fourth, the Federal Reserve has signaled it's done raising rates. In fact, they've already started cutting. If the economy slows and inflation stays under control, the Fed will likely cut rates further in 2025. If that happens, the interest burden on floating rate loans eases. A company that was paying 11% on its debt might see that drop to 9% or 8%. That gives the company more breathing room, more cash flow to reinvest in the business or pay down debt. It doesn't solve the problem if the company's underlying business is broken, but it does buy time. And in finance, time is often enough to avoid a default. So it's not a foregone conclusion that this all implodes. The question is whether those offsets are enough if we get a real recession, if unemployment spikes to 7 or 8%, if corporate revenues fall by 10 or 15%, if consumer spending drops sharply. In that scenario, I don't think covenants and sponsor support are going to be enough to prevent a wave of defaults. And once that wave starts, the liquidity mismatch problem kicks in, and that's when things get dangerous. So where does that leave you as an investor? Here's what I think matters for someone managing a retirement account or a long-term portfolio. First, check your exposure. It's because the valuations are modeled, not market priced. When defaults start showing up, the returns will reprice sharply and suddenly. You'll see a year where the fund is down 15 or 20%, and it'll wipe out years of those steady gains. If you're relying on those funds for income or liquidity in the near term, that's a risk you need to account for in your planning. And finally, diversification still matters. If you have exposure to private credit, make sure it's a small enough slice of your portfolio that even if it gets cut in half, it doesn't derail your overall plan. I'm not saying dump everything. I'm not saying private credit is going to zero. I'm saying size it appropriately for the risk you're actually taking, not the risk the marketing materials say you're taking. This is educational content based on publicly available information and my own analysis. It is not personalized financial advice. If you're unsure how this applies to your specific situation, talk to a licensed financial advisor who can review your full picture and help you make decisions based on your goals and risk tolerance. The private credit market isn't going to zero, but it's also not the free lunch it's been sold as for the last decade. The Moody's downgrade of Blackstone is a signal that the risks are real, and they're starting to show up in ways that matter. The cracks are forming. The question is whether those cracks turn into something bigger and whether you're positioned to handle it if they do. If you're invested in this space, now is the time to understand what you own, how it's priced, and what happens if the economy turns. Don't wait until the redemptions are gated and the losses start showing up. By then, it's too late.